In the span of 48 hours, the silver market absorbed a flow shock that would normally be spread over an entire quarter. 8 billion of notional pressure landing on a market that already trades on timing-sensitive liquidity. At the same time, the rules of the game shifted. On January 13th, 2026, the exchange framework for precious metals margins moved toward a percentage of notional method that can rise and fall with price and volatility. That is the kind of structural change that rewires behavior, not just sentiment. They said this could never happen in the modern era. They said the market is too deep, too electronic, too well managed for any real strain to show through. Yet strain is showing, just not always where people are trained to look. Institutions already understand how to read these signals. They study flow schedules, margin frameworks, clearing mechanics, and vault ledgers. They can see stress forming, dissolving, or migrating before it ever becomes a headline. Most observers only see the chart and assume the move was a motion. The most important detail is the asymmetry of attention. Desks read the notices, run the settlement math, and model what happens when forced flows collide with higher collateral. Everyone else reacts to the candle after it prints. That is why this moment feels impossible. The public story says silver trades like any other commodity. The plumbing says it does not when buffers thin under stress like this. Not months, not weeks. In 48 hours, market structure tilted. And when structure tilts, price does not just move. Price starts behaving differently. What I am about to lay out changes how the recent silver action should be interpreted, because the squeeze did not end, it shifted. And inventory drawdowns change everything. Welcome to Roki Macro, where we decode what matters before it becomes the story everyone repeats. If you have ever felt like you hear the real explanation 2 weeks after the move, you are in the right place. Consider subscribing the way you would keep a wise elder in your circle, not for noise, but for clarity. And tell me in the comments where you're watching from, because this market is global, and the first signs of strain often appear in different places first. Now let's reconstruct what actually happened, step by step, with the kind of detail the price chart never gives you. The first force was mechanical selling. Between January 8th and January 14th, index rebalancing implied a concentrated wave of futures selling in silver. Mechanical is the right word. It is not fear. It is not conviction. It is mandate. Funds tracking an index must trade to match the index. If the rebalance implies less silver exposure, they sell, and they sell within a defined window. The market cannot negotiate with mandate. It can only absorb it. The second force was the change in carrying cost. On January 13th, 2026, the exchange shifted precious metals margin methodology toward a percentage of notional framework. In simple terms, the amount of collateral required to hold a contract becomes more sensitive to price and volatility. A fixed margin can be planned around. A dynamic margin that scales with notional and volatility is harder to plan around in fast markets. That pushes the market toward participants with deeper funding and away from participants who rely on fragile leverage. Put those together and you get a setup that creates sudden air pockets. A large, scheduled wave of selling collides with a market where staying leveraged becomes more expensive right when volatility is highest. That combination does not just move price, it changes behavior. Liquidity providers widen spreads, risk managers tighten limits. Traders who would normally ride out noise are forced to reduce exposure. The tape can look irrational even though it is reacting logically to new constraints. Here is where it gets interesting. While the paper market was being reshaped by margins and flows, the physical signals did not line up neatly with the calm narrative. 3% decline from the prior month. On its own, that is not an emergency. But direction matters. Timing matters. Inventory is not just a statistic, it is a buffer. And buffers matter most during shocks. To understand why, you have to remember the silver market's personality. Silver is smaller than gold, more industrially entangled, and more prone to sudden liquidity events. In calm markets, it trades like a commodity. In stressed markets, it trades like a referendum on trust. The same metal can be treated like raw material one week and a monetary asset the next. That dual identity is why squeezes in silver do not always look like squeezes in other assets. Pressure can migrate between layers of the system. That brings us to the hidden pattern. This is not the first time silver surges collided with exchange mechanics and collateral rules. In 1979, silver entered a phase of accelerating price action driven by tightness, narratives, inflation fears, and aggressive positioning. The result was a dramatic spike that ended with rule tightening and the market violently repricing risk. In 1980, the defining feature was not simply that price reversed, it was that leverage stopped being tolerated on the same terms. And once terms changed, the market structure changed with it. Fast forward to 2011, silver rallied hard into the spring, pulling in momentum and leverage and a fresh wave of new era arguments. Then margin requirements were raised multiple times in a short period. The effect was immediate, forced deleveraging. Price fell faster than most narratives could update. The lesson was not that silver cannot rally. The lesson was that in silver, the exchange can change the carrying cost faster than participants can change their beliefs. Then look at 2020, when broader markets seized and even highly traded assets behaved in strange ways. Silver experienced moments where liquidity vanished, spreads blew out, and the relationship between futures prices and physical availability became noisy. The lesson from 2020 was that stress can temporarily break the neat link between what the screen says and what it takes to source real material. That is exactly the kind of environment where the market starts pricing the plumbing. Now look at 2026. A margin framework evolves toward collateral demands that scale with notional. Index-linked funds execute mechanical selling into a short window. Physical inventories drift lower in the background. Expert commentary splits into camps that talk past each other. One camp focuses on speculation and bubble dynamics. Another points to physical friction, refinery backlogs, and the recurring pattern of tightness emerging when paper selling spikes. When smart people disagree while the rules are shifting, it is often because the market is transitioning between regimes. And that is the key point. The squeeze did not simply break, it shifted. When the cost of holding paper exposure rises at the same moment that physical buffers are not expanding, pressure does not vanish. It relocates. It moves from one part of the system to another. It changes who bears it. Let's talk about the players, because this story is not about anonymous markets. It is about institutions and incentives. First is the exchange, the venue where futures are margined, cleared, and settled. When margin methodology changes, behavior changes. Higher, more dynamic collateral requirements tend to reduce speculative leverage, especially for participants who rely on short-term financing. That can stabilize the system, but it also means price can move sharply as leverage is withdrawn quickly. Second are the index tracking funds and the broader systematic complex. Their trades are often predictable in timing, but unavoidable in execution. When a rebalance implies selling, they sell. The market's job is to find a price that clears that transfer of risk. If liquidity is thick, it feels like a non-event. If liquidity is thin, it becomes the event. Third is the vault ecosystem that supports the wholesale market, with London as a central node. Vault figures are not a perfect map of global availability, but they reveal the size of buffers that back a large share of the trade. A slow decline in inventory is like lowering the water level in a reservoir. You might not notice daily, but when conditions dry out, every inch matters. Fourth are banks and dealers that operate across paper and physical channels. They hedge, they borrow, they lease, they roll positions. Their job is to keep the system functioning, but they also respond to incentives. If carrying risk becomes more expensive, they reduce it or reprice it. If sourcing becomes slower, they widen spreads or demand better terms. Their actions often appear as mysterious price behavior, but it is usually risk management under new constraints. Fifth are industrial users and fabricators, the demand side that does not care about slogans. They care about availability, lead times, and cost certainty. When volatility rises and physical tightness chatter spreads, industrial buyers often adjust behavior. Some pull forward purchases, some delay, some hedge more. These shifts do not always show up immediately in headline price, but they show up in flows and in terms. Now connect the dots through timing. A margin framework shift lands mid-month. An index rebalance window compresses flows into days. Vault data shows drift lower over the same period. Narratives split into bubble versus shortage. And the market does what it always does when narratives diverge. It punishes certainty. This is the part most people miss. The dislocation is not just between two opinions. It is between two measurement systems that do not reconcile quickly. On one side, you have the paper market, where price is discovered through futures contracts that can be created and closed rapidly. Liquidity can look abundant because contracts can be issued and offset without metal moving. On the other side, you have the physical system, where metal must be refined, transported, assayed, and allocated. That system has inertia. When stress hits paper, it can clear by changing price. When stress hits physical, it clears by changing terms, delaying delivery, or rationing availability. When those systems send opposite signals, you get the recurring silver phenomenon. Futures price can be pressured down by forced selling and margin-driven deleveraging. At the same time, physical availability becomes more constrained. The chart says weakness. The logistics say friction. If you watch only one side, you misread the regime. Quantify the scale in human terms. 13,000 futures lots is not a casual number. Each standard COMEX silver futures contract represents 5,000 ounces. Multiply 13,000 by 5,000, and you get 65 million ounces of notional exposure shifting hands in a tight window. Spreads widen, financing terms change, and the premium for immediacy rises. Notice what all three scenarios have in common. They are not about a single target number. They are about mechanics. They are about who is forced to act and when. So what should be watched if you want to understand which path is unfolding? Watch the plumbing. Watch how margin requirements evolve relative to volatility. If collateral demands keep rising as price moves, the system is leaning against leverage. Watch the timing and magnitude of index flows, because mechanical selling or buying can create temporary distortions that look like trend changes but are really calendar events. Watch vault trends over multiple months, not a single print, because direction matters more than drama. Watch for persistent divergence between futures behavior and physical sourcing conditions, because that is often where the shift reveals itself first. Also watch the signals that reveal stress without shouting. Pay attention to whether the market shifts toward backwardation or contango, because that hints at whether the market is paying a premium for immediacy or for storage. Pay attention to exchange for physical activity and unusual spread behavior, because those can reflect participants trying to move risk between paper and physical channels. Pay attention to lease rates and financing chatter, because that is where tightness often surfaces first before it becomes a headline. And watch narrative speed. In silver, narrative flips often lag positioning changes. When you hear everyone suddenly agree on one story, the market is often already migrating to the next phase. Institutions move first because they are watching flows, rules, inventories, and funding conditions. Retail moves last because it is watching headlines. This is where the divide forms. Not between optimists and pessimists, between those who treat markets as stories and those who treat markets as systems. Those who understand this do not have to be brilliant. They just have to be disciplined about what they observe. They accept that in silver the same headline can be true and misleading at the same time. Price can be down while sourcing becomes harder. Speculation can be high while buffers thin. The market can be both overextended and tight, depending on which layer is under stress. Those who miss it tend to anchor on a single frame. They see a chart and assume the chart is reality. Or they hear a shortage story and assume price must immediately reflect it. But the world is messier. Price reflects the marginal trade in the dominant venue. Availability reflects constraints in the chain. When those drift apart, the important thing is not guessing a number. It is recognizing transition and noticing where the squeeze relocated. Inventory drawdowns change everything because they reduce the system's tolerance for shock. They thin the buffer that smooths the gap between paper promises and physical fulfillment. At the same time, margin frameworks that scale with notional reduce the system's tolerance for leverage. When both buffers shrink, the market becomes more prone to abrupt repricing events. Not guaranteed, more prone. That is why the next major move in silver may not look like the last one. It may not be a clean squeeze with a single dramatic climax. It may be a sequence of dislocations, resets, and sudden liquidity events that slowly rewire how silver is priced and sourced. It may be paper weakness alongside physical tightness. It may be calm followed by sudden gaps. It may be an environment where the most important information is not on the chart at all. This is Roki Macro, where we decode what matters before it becomes the headline everyone repeats. If this connected dots you had not seen, you know what to do. The real question is not whether the pattern unfolds. The question is whether you recognize the shift while it is still just data, not a story. That does not mean 65 million ounces will be delivered. But it does mean the price-setting instrument is absorbing a shock equivalent to a meaningful slice of annual mine supply compressed into days. That is why it matters. Now consider the vault buffer. 27,929 tons is enormous in absolute terms. The point is not the size. The point is the cushion. 3% monthly decline sounds small until you remember that in tight systems, small declines reduce the margin for error. When the cushion thins while paper leverage is being constrained, stress migrates. Instead of a simple headline-friendly futures squeeze, you can get stress expressed as higher financing costs, wider spreads, more frequent delivery frictions, and a growing premium on immediacy. Now, let's explain the mechanism in plain language, because this is where most commentary turns into fog. Think of the futures market like a highway built to move promises at high speed. Margin is the deposit you leave at the gate to use that highway. When the exchange switches that deposit to a percentage of notional, it is like the toll suddenly depends on the price of fuel in real time. If price spikes, the toll spikes, even if your position size does not. When that coincides with a scheduled wave of index selling, it is like sending a convoy of trucks into the same lane during a storm. Liquidity providers step back because they cannot hedge at tight spreads. The spread widens, which makes it more expensive to move size, which pushes more participants to reduce exposure, which widens spreads further. That feedback loop is not conspiracy. It is the math of risk limits. Here's the subtle twist. Margin changes can create selling pressure even if the underlying thesis has not changed. A trader can be right and still be forced out if funding is mismatched to the new rules. That is why these events often mark turning points. Bring the numbers back in. 44 per ounce. A standard 5,000 ounce contract represents about $457,200 of notional value. A 9% performance bond on that is roughly $41,000 per contract. Multiply that by thousands of contracts across the market, and you can see why collateral becomes the bottleneck. It is not metal scarcity that forces selling in that moment. It is cash scarcity. And cash scarcity is what turns an orderly market into an air pocket. And if sentiment breaks hard, you get analysts talking about a slide toward $68, roughly 17% down from there, which would feel like collapse on screens even as the physical layer tightens quietly for certain buyers. This also explains why you can see bearish price action alongside bullish physical chatter. Futures can be pressured by cash and flow mechanics at the same time. Refiners, fabricators, and wholesalers talk about lead times, allocation, or premiums. Those are different layers of the same system reacting to different constraints. Now build the evidence stack, because this is where we move from story to structure. Evidence point 1 is the scale and timing of index-related selling. Billions of dollars of notional pressure, concentrated into a rebalance window, creates a predictable stress zone. Predictable does not mean harmless. It means institutions can anticipate it, position around it, or demand compensation for providing liquidity. Retail tends to experience it as a surprise. Evidence point 2 is the margin methodology shift. Even if you ignore the exact formulas, the concept is enough. Collateral demands become a moving target. In a rising market, that is a brake on leverage. In a falling market, it can be an accelerant because falling prices can raise volatility, which can raise margins, which can force sales, which can raise volatility again. That is how small shocks become big moves. Evidence point 3 is the inventory drift in a key vault system. A modest decline is not a crisis by itself, but combined with other stressors, it changes the probability distribution. It makes extreme outcomes more likely at the margin. Markets are moved by tail risk, not the average. Evidence point 4 is the contradiction in expert takes. Some emphasize speculative excess in downside scenarios. Others emphasize physical frictions and recurring tightness patterns. When credible observers disagree while positioning is being reshaped, it often signals a regime transition. Here is another piece of evidence that hides in plain sight. The market's obsession with headline price often distracts from settlement choices. In quiet periods, most participants roll contracts and settle financially. In stressed periods, a slightly higher fraction of participants start caring about what can be delivered, when, and in what form. Even small changes in that preference can matter because the physical system cannot expand on a dime. That is how a squeeze can shift from price action to terms, from the chart to the plumbing, without announcing itself. So what does this mean going forward? Not as a prediction, as a map of how these patterns usually resolve. Historically, when margin mechanics tighten into volatility, you tend to see one of three paths. The conservative path is controlled deflation. Forced selling clears leveraged positions, price retraces, volatility falls, and the market resumes trading more normally, with physical tightness narratives fading. This path feels like the squeeze failed, but really it means the paper market succeeded at transferring risk away from leveraged holders quickly. The moderate path is a two-speed market. Paper price remains volatile and sometimes weak due to periodic flow shocks, while physical premiums, lead times, and allocation constraints become the real story for those who need metal. The result is a creeping dislocation where official prices and real sourcing costs diverge. This can persist longer than people expect because institutions can tolerate dislocations if they can hedge them and if most participants do not demand immediate delivery. The aggressive path is a sudden repricing of deliverability risk. This is the scenario where a new shock hits while buffers are thin and confidence is already stressed. It can be triggered by a surge in physical demand, a supply interruption, a policy change, or a scramble for specific deliverable forms of metal. In that scenario, the market does not just move in price. It changes behavior.